Good Friday afternoon. I'm Jeff Hirsch, editor-in-chief of the Stock Traders Almanac, and this is WealthWise on Biz Talk Today TV. I've got a very special treat today. I've got a real legit technician who's also a CFA to help us ascertain where this wild market is headed. Frank Cappelleri will join us in just a few minutes, but everyone is looking for bottom. In my experience, when people stop asking, is this the bottom, is more likely the bottom. So let's look at a few things that are on my radar. I'm going to share my screen, and we're going to look at the history of these big two-day 10% declines. I've been advising to wait for a fatter pitch. You can see we did have a big day. Let me see if I can get my, there we go. There's my little pointer up here. We did have a nice week following the 10% decline. Good news is that, after 6 months or so, this tariff tantrum should be behind us, but this is not the kind of company we'd like to be keeping. All previous instances of this two-day 10% drop were bear markets, recessions, and/or a war. We've sort of, this 33, there was a day that was backed out. There was 3 days in a row that the first 2 days were down 10%, and the second and third days were down 10%. So we just had the last one here. But the other thing that we're looking at, we pulled out an old study that Yale, Hirsch, my illustrious late father, who started the Almanac, came up with back in 75, where he made a call based upon this waterfall declines that the Dow had hit 800, believe it or not, back in 85 after the 74 low. But what we're seeing here is that most bear market bottoms since 1950 were preceded by these waterfall declines, about 12 to 28%. There's a little leeway here, and this usually over 2 to 4 months in duration. We see this fear and desperation and helplessness that characterizes the sentiment at bear market bottoms, a lot like we had on Thursday before the big turnaround and the pause. But what's remarkable here is that on average, we get from the low, from the bear market low that was, ended with this waterfall decline, it takes about 5 months on average to get back to where we fell off the cliff. There's a couple of other dates in here, and this was put out in the newsletter. You can go back and study this, but basically, aside from some extenuating circumstances, for the most part, once you hit that bottom, not that we've hit it yet, it takes about 5 months or so, or 3 to 8 months to get back to where you fell off it. So we've got that going for us. The other thing that I'm still concerned with is the post-election year trend. I know Frank has tracked this a bit. I've seen him pick it up in his work. This is, I brought back the full chart. This is the one that initially had in the Stock Traders Almanac outlook for 2025, adding in the brown line here, or beige, whatever it is, for 25. You can see that we're below much of all the different seasonal patterns here from 1949 to 24. The incumbent party wins line, the all election years line in black, my aggregate cycle, which combines seasonals, the 4-year cycle, and the 5th-year decades of the decennial cycle, this 5th year of presidency, the second term, and then the red line here, which is when an incumbent party loses the previous year, which we had happen. So well below all of that. Then, we've got these bearish post-election year trends. On page 28 of the Almanac, we look at the difference in post-election year behavior, performance under Republican administrations versus Democratic administrations. Midterms tend to be rough for the Democrats. Post-election years rougher for the Republicans. They tend to come in and take care of their least savory policy initiatives first. We're seeing that very acutely this year. So I've got, and then, as noted in the Almanac, post-election years have been better since 85. So we've got this Republican administration line. There's a bunch of rough years, 69, 73, 57. This is the Republican administrations from 53 to 81. We've got all Republican administrations about flat for the year since 1950, and then the incumbent party loss line still kind of a paltry 5% gain. But this year we blasted through all that. You know, as I've said several times, if we can get April, the market, we can get April in the green, which would be quite an undertaking. That would be pretty positive, and you know, I think it's going to be hard to do, but that's what we're looking at from the post-election year trend standpoint. Still kind of bearish. I brought up my technical support chart because I got Frank on, and this is some of the things we're looking at. You know, today's not on this chart because I like the drawings that I have here. Would we close at about 53.50 or something like that? We can figure that out in a moment. But it's still below this area. Yes, we had a huge snapback rally up into this sort of yellow zone, which here's this potential W123 swing bottom I had highlighted before. We blew through that. That becomes some firm resistance in my view. It's the old election gap that used to be, that was the resistance in the middle of the W. That got taken out. I had drawn this trend line from the April lows through the August lows. We came right through that. The old April highs, early April highs from 24, we cut through that. April lows, we cut through that. So to me, there's not a whole lot of room down below this support. If we can hold this 5,000 area, 49.50, whatever it is, that would be encouraging. I put this 4,800 as I know is a level that Frank tracks back to. We'll talk about that in a minute. Back to I think it was the 22 lows, if memory serves. We'll look at his weekly chart shortly. And then we've got the midsummer 23 highs and the January lows, this 4,600, 4,700 area. Below that, the 23 lows come into play, 4,000, 4,100. And then the pre-COVID highs, which is way over here, not on this chart, and the 22 lows, which are 3,400 to 3,500. So where we find support is anyone's guess. If we can find it here, that would be very encouraging. So I'm going to close my deck for a minute here and then bring Frank on, and we'll have a little discussion. I mean, basically, as Frank comes in, we're still in a trade war with China. The 90-day pause doesn't change that. I think less equity exposure is in order until we get more clarity on the tariffs, the trade war, and economics. My worst case scenario is still in play for a flat to negative year, about 50-50. There's an increased likelihood of recession, but this too shall pass, as my mother used to say. But it's likely not over yet. The time to buy will present itself over the next several weeks or months. For now, I think it's best to sit tight and keep your powder dry. The bear has reared its ugly head. A recession is quite possible. So, Frank, welcome. Glad you could make it. Frank's the founder and president of CappThesis. His firm helps active investors profit through technical analysis. I know he uses financial, other analysis as well, fundamental analysis. He's been on the street for 25 years. He was at Instinet, Nomura, Smith Barney. He's a trader, technical analyst, research specialist, strategist, and most impressively, he has both the CFA and CMT designations, and he's a CNBC Pro contributor. So, Frank, welcome. Thanks for coming, man.
Thanks a lot, Jeff. I've been a fan of your work for many, many years now, so it's a pleasure to be here.
It's good. We've been missing each other at a few events and a few things, but we've been tracking each other on the LinkedIn and other posts. So, you were on Wall Street for 25 years. I mean, you look like you're maybe 25. What was the epiphany to go out on your own?
Well, great question. Just to give you a brief, I guess, history. So I started my career working at Smith Barney with two technical analysis pioneers, Alan Shaw and Louise Yamada. And
Oh, wow.
I didn't know anything about technical analysis.
Alan Shaw and Louise Yamada. Let's
Yep.
make sure everyone knows those names.
Yeah. Looking back, wonderful experience. I still speak with, Louise. She's still has her hand on the market, and she's a wonderful woman as well. So that was 1997. That was in the middle of the internet, bubble, and then burst. And, I just learned a lot of the basis of technical analysis, not, in particular, how to talk to both institutional clients and some retail clients I talked with as well, because that was a very big part of Smith Barney back then, which has since been sold to Morgan Stanley. From that point, I went to Instinet where I was there for 22 years, initially as a junior analyst, so saw the bubble burst there, and then spent 16 years as an institutional uh, equity sales trader. So was there during the thick of that, obviously, the great financial crisis. And so that was much different responsibilities I had back then. It was, obviously you're responding to all the requests of the buy side traders, and I started talking more to analysts and PMs and started doing more content. And so toward the end of that, I had to make a decision. Like I was getting requests from content, I was doing more of it. But again, if you're a sales trader, you have to be on it. And I felt like I could give as much attention to that side and could add much more to the firm and the clients by doing some more content. Which so in the last few years there, I moved off of the desk and into more research role, and then as a desk strategist at the end. And so because of that, I got more conversations, and it gave me,
Mhm.
thought that I want eventually to do something on my own with this. So I talked to a number of people, thought it was good. It was getting a lot more requests from outside of Wall Street, some financial advisors, saw some of the content other places. And that's what really, encouraged me to start CappThesis. And so a lot of the same type of content I provide now, and talking to as many of those on the buy side counterparts, I got an idea, right, of what some of the biggest and most successful financial institutions found useful, and I felt that it could also be helpful to financial advisors, active investors as well. And so at CappThesis, provide a lot of different forms of research, but it's really looking at things from a big picture point of view, getting a
Mhm.
market stance, identifying the major trend, and making then trade recommendations based on that trend. So we go from, again, very big picture, looking at all the
Mhm.
asset classes, all the way down to making specific stock trade ideas with, exit points on both the upside and downside.
So was this research kind of came out of your trading, what you were researching for your own trading, and then people started seeing it and wanting more of your research and less of you trading? Is that how it evolved? Is that what I'm hearing?
Yes and no. You probably understand, Jeff, that if you're at a financial institution, they frown upon personal trading pretty much. But at the same time,
I mean, working on a trading desk. I didn't mean personal, but
yeah, no, yeah, exactly.
the
So
research that went behind the trades that the firm was they were making for the firm.
yep. Well, a lot of it was just advising. So, for instance, if you're a buy side trader, and you have millions of shares of stock to use, so that's coming from a portfolio manager who has a big picture view. So, understanding that, and then trying to pick the right spots on a short term basis to help generate alpha. So, I think having those different roles there, I kind of understood the life cycle of a trade, if you will, right? And people looking at it different ways. You have the buy side analyst, of course, trying to identify the right stocks, and the portfolio manager using that as part of his bigger puzzle. Then obviously the trader has a very big responsibility to make sure that it gets some good prices. And if you're on the sell side, you have to help with that process. And toward the end there, I was able to talk to each one of those counterparts on the other side to understand how each of them are thinking.
So what areas do you cover mostly? Everything, currencies, bonds, stocks, or mostly equities, or all of it, commodities?
Yeah, I look at all of it for inputs, but most of it are equities. And it's, I think that's a very interesting part of the business where you really have an ETF or anything. You can,
Hmm.
express your interest any way. You don't need to,
There's more
you know,
ETFs than stocks now, right?
yeah, probably right. And so you don't need to have a currency background to understand how you could, express your interest, with that. So I spend a lot of time talking about ETFs as
So
well.
it's a newsletter service, and you provide your research to clients. You have a lot of individual investors, or mostly institutional.
There's both. There's both. Yeah, I have still taught to institutions as well, and a lot of that is, the product is more access to them. So talk a lot of strategy on that side. Otherwise, people that find interest in this can go to the website and subscribe to different packages that we have there.
The website is
Capthesis.com.
hard. That's a hard one. Cap with two P's, right? Yeah.
Yeah, nicely done.
Um. So why both CFA and CMT?
Well, again, I was very young and didn't know which one to choose, but I was sitting in the midst of a big fundamental research department. And so even though I was with technical analysis, and I'll tell you the story, when I came out of college, there was a good job market back then, and I got
Yeah.
two different offers from Smith Barney's research.
Oh
One
yeah.
was to be an assistant with automobile analyst. And I was like, what 22-year-old isn't really fancy about driving around
Right.
cool cars and going
Right.
to all the auto shows? But in reality, I knew you would never get close to that. Just be in a spreadsheet typing away. And then it was technical analysis. And I was like, number one, they had this huge chart room, people, a lot more space than anyone else here. And it was like, I don't know much more about the market, but what I learned about it, and then I can pick the sector that appeals to me and, and CFA will help with that. So I started that process. Actually, I started taking both exams at once. So if anyone who's in thinking about doing it, don't do that
No.
because you got to
No.
focus on one at a time.
Wait. So which one's harder?
Well, CFA is much more vigorous and rigorous. It's
Really?
I shouldn't say that. And I also liked technical analysis much more. So I enjoyed that process. So I think going through all of that, it really pushed me in that direction because it just felt right. It had more of an interest in, the trading aspect of stock as opposed to going deep into, the fundamentals of companies.
You lean a little bit more technical, I think, right?
Oh yeah,
Yeah, yeah.
100%.
So you got them both in 97?
No, I graduated from college in 97. I think I
Graduated in
got
97.
Yeah, it took a while because I was a lot of, I was changing jobs, got married,
Uh-huh.
so things kind of got paused for a while. But after, 6 or 7 years, had them both, and that was a good day when all that was done. Let me tell you.
I bet it was. So let's cut to the chase. Are we in a bear market or not?
Yes, and
Yes.
I say that.
Woohoo! I love it.
Yeah, well, I'll say that we can look at this as 20% down defines the bear market. I like to think of it as we're seeing bear market price action regardless of where we are in terms of measure from a top or so. It could be down 5%. And the way I look at it is things really started to change, as January developed and February, where some of the things that I track on a daily basis that kept us in the uptrend over and over again started to flip, started to see some cracks. And then, of course, when things, I would just say, didn't completely roll over, but when February ended and March began, it just you could tell that things were a little bit different. And then, of course, it's been accelerated to a lot now. And even with these big moves, one of the characteristics of bear market is just exaggerated daily moves like
Hmm.
that. You don't see that in a bull market, and you don't see the types of things that help a bull market, meaning that bullish patterns form and you get clean breakouts, right?
So
So
what are the things that you're tracking that are telling you this?
yeah, so again, one of the things is just I track the number very simply the number of 1% excuse me, 1% advances and declines the S&P has on a rolling monthly basis, right? And so to give you an example, from in 2022, almost every month had at least 10, sometimes up to 13 of them. So that just shows high two-way volatility. 2023 and 24 wasn't the case at all. Hardly any of them even cracked 10, and that helped, again, define how the market was in pretty tranquil
So
advance.
less 1% daily moves in an up market and more in a down market.
And well, 1% moves up and down. Yeah.
Up
Yep.
and down, right.
Right. And so also, within that realm, you still want to see more 1% moves than 1% declines. Very simple, but back in 2022, there were 130 plus or minus 1% moves for the year, just about 65 down, 63 up. So as we know, the
Yeah.
biggest moves happen in response, the biggest advances happen in response to biggest declines. We also have a high frequency of them. And that in 2023 and 4, not nearly as many. But that just meant that the market was more consistent. So now we come to now, in March, we had 13 of them, right? So the first time that happened since September 2022. And now we've had 9 trading days and 7 of them have been at least 1%, obviously much more than that. So, we could be off the low, who knows? But when I'm looking back at this, I'm trying to compare it to 2022, 23. And when that changed from my work, really wasn't until the second quarter of 2023. That's when those number of 1% moves fell off a cliff. And that then coincided with bullish patterns starting to work in breakouts. So, I'm never going to call the bottom, but
Hmm.
at the same time, that way of looking at the market allows us to identify regime changes and ride most of it,
So it
especially if
took
those.
about, would you say the second quarter of 23
Yeah.
until, okay. Did you have any of the 4-year cycle overlay on that? I mean, October midterm election year, October was and the sentiment being down was a big, warning sign, a big green light to me. I mean, I got pretty bullish back in 22. I got lucky because everything lined up. Seasonals, 4-year cycle. That's something you have an overlay on, right?
I do, and I use your stuff a lot, and a lot more recently, I should say as well. And I find that that gives me confidence in situations like this, where if still waiting for some signals to go,
Right.
and knowing that we're getting close to an end of something that you pointed out, I cite it all the time.
We all should have paid more attention to the long history of post-election years coming in this year,
Yeah,
myself included. I was a little bit, swayed by the recent since '85 pattern of post-election years, but we are getting an old school post-election year comeuppance right now. We'll see if this bottoms out. As you said, nobody knows where that bottom is without a little hindsight, but it was there for us. What else are you looking at in these uptrends that and when did you sort of see the bear emerge? Like, was it a couple of days ago, this week? When were you convinced that we're in a bear or that we had the bearish traits?
well, I'll give you just a quick breakdown from what I saw from December until now,
Right.
quickly. But so from October 2023 to December 2024, from my count, the S&P 500 had 11 bullish patterns form, 11 successful breakouts, meaning that broke through resistance, did not revisit, right, had a clean breakout, and eventually hit a target. That doesn't happen a
All
lot.
all technical patterns.
All technical patterns. So 11
So
straight.
rattle off some of these pattern names.
Cup and handles, inverse head and shoulders pattern, just regular trading ranges. So basically,
Okay.
it's just a digestive phase that was resolved to the upside over and over again.
Right.
And along the way, I only saw one time we had a bearish pattern hit a target, and that was during the crazy August of 2024, and it happened within 3 days, right? Those
Yep.
beginning stages, and then everything was reversed. So in December,
Weak seasonal period
there
as
you
well.
go. That's all we need, really, right? Know that. So we get to December, and getting closer, we saw some weakness, underneath the surface, but then that was the first time it was a small inverse head and shoulders pattern fail. So I noted it, be like, well, it's small, but sometimes that happens. You just need a lot of volatility sometimes to create these biggest patterns, right? And then that corrected itself, and you get to end of February, right? You break out through 61.50, had 3 days of a follow through, reversed lower again, and then a few other small ones. And then at that point, you started to see bearish patterns develop. And then it was like, you know what? This feels a lot different. Didn't have this before, and started getting more, 1% advances or and declines as well. So I would say by the time the beginning of March happened, it was risky, and then of course everything started to fall apart.
So what are these bearish patterns that have presented themselves that you've seen since December? The failed head and shoulders in December,
That was a failed one. Yeah, there were a
the
few failed.
reversal in February, right?
Mhm. And then when, if you recall, in the middle of March, we had that little rally, some stabilization around March 13th, the 20th, around there. Those are all different patterns that formed, small ones, bullish patterns. They failed. But at the same time, that we saw the first bearish flag occur. And
When was
that
the
at the
flag?
time, I have was a downside target of
I'm gonna
5,025.
pull up my S&P chart because I think it's important to talk about that. I'm
Yeah.
just gonna throw an audible in here. Um, so this is the failed. This is the head and shoulders right here in December.
Well, that was a failed bearish pattern. One didn't really work out. But I was looking more. The one that really struck me was after we had the breakout fail all the way in the middle of February there, the February 19th high,
Right,
right there. So that was a big cup and handle pattern from my perspective, connecting the highs from December to that. Yep.
right.
So that failed. And then the way down inside there, you can't really see it as much there, but I sometimes look at shorter term charts to identify
Yeah,
patterns when it's like that.
sure.
So that consolidation failed. And then you go down to the middle of March after the initial fall, and then that rally back up there, where you had the two there. That
That
again,
failure right there.
that was a failure, but that also ended up being a bear flag pattern, right?
This.
And then that target was down to 5,025. I remember putting it out there before anything really bad happened.
Yeah.
Uh, and got some pushback. That's pretty substantial. I'm like, I agree, but this is all data driven, right? We respected the breakouts on the way up. We have to respect the breakdowns on the way down. As long as the breakdown zone holds, we have to think that that's a possibility, which of course that was hit as things fell apart on this past Monday.
All right, I'm going to take this off. I'm confuse everybody. So, let's pull up some of your charts and talk about some of the things that you're seeing there. So these are some bearish market characteristics charts. I'm gonna share this again here. This is appreciate you sending these in here. So
Sure.
this is new 52-week lows picking up. I mean, this is kind of technical, but I mean, is our market internals technical analysis, or is that part of that's considered technical too?
Oh, definitely. Yeah.
Yeah.
Without a
So
doubt.
we track weekly new highs and new lows a lot in the newsletter. I think you've seen that. So what are we looking at here?
These are just the number of new 52-week lows. This is a daily chart going back to 2005, so 20 years worth. And so what struck me was that as just a few days ago, I think it was Thursday and Friday or Friday, Monday, I forget which ones, but we had 2 straight days when there was over 130 stocks making new 52-week lows. And that came like, not I want to say out of nowhere, but we had like numbers percolating in the 30s and 40s before that, but that just took out everything almost. And so I think from this, when that happens, it's very good. You see, have to go back in history and see some perspective there. And of course, they're the most volatile times, the bear markets.
These are bear markets highlighted, right?
Yeah, well, the biggest ones are. So what I wanted to show there was in 2022, and of course the great financial crisis, two things. Number one, that number got a lot higher. So you see that right at the almost at the low there.
And
One
more
day.
frequent as well is what I'm seeing. There's a lot more of these.
That's exactly the point, Jeff. Yes.
Yeah. So this is kind
I
of
knew
like
you
the
wouldn't miss that
beginning.
one.
What's that?
I said I knew you wouldn't miss that one.
And this is New York Stock Exchange or all new lows?
Just S&P 500 only.
Just S&P 500 only.
Yeah. Yeah. So the point being is that, we may get more, if the market goes down again. So I think the point being is that, like you said, we get clusters of these in the longest bear markets and the toughest markets like this. And so here's a, for instance, where we could look at in a positive. If, for instance, say the Mag 7 stocks and they'll like continue to struggle, but the rest of the market, the field, they call it, does a lot better, then you may see that the S&P kind of hovering near its lows, but this number of new 52-week lows not get any worse or actually start to get a lot better, right? So that's a divergence we could possibly look for. But if the S&P starts making a new low, then this continues to spike, then of course we have to think that we have to go through this for longer than we've had so far.
Still early, too early to tell, basically.
Without a doubt. Even the ones highlighted in yellow, they look relatively quick, but they were painful. 2011, that was number of months. Obviously, 15 and 16 was a tough time as well.
Oh, I jumped to the next
That's
one.
all right.
I'm sorry.
Yeah.
No. So this is weekly moving averages. So we're looking at going back to 22. Tell me what we're seeing here.
So I think the good part about having 2022 happen is that we can reference it, and it's not too much of an outlandish time that we can think that it could happen again. So for instance, back here, I'm using the 13-week, 26-week, and 40-week, which just represents 1/4 of action, 2/4 of action, and then 40-week is 3/4, but also very close to the 200-day moving average. And so in 2021, as we can tell, the beginning of that chart, when the market peaked and started to roll over, all those moving averages started to roll over as well. So that did two things. It just showed that longer term momentum was flipping from positive to negative, and then those lines where the S&P was trading above and we're slipping higher, now we're sloping lower, and now they turn from support to resistance all
So
the
this
way.
is like a clearer death cross to me, because when the 50-day crosses below the 200-day, everyone talks about this death cross. It's been close to lows in a lot of situations. So this is when we're seeing the 13-week come below the 26-week and the 40-week. And on a daily, what does that equate to on a daily moving average, since you probably know it off the top of your head?
Well, the 40-week is like a 200-day.
And this 26 is like a 50 or a little bit more? It's a little bit more.
Yeah, a little bit more. Yeah. So regardless, I think it just shows that you're just showing different versions of the moving averages, faster crossing over, slower, which is the death cross, whatever you want to call it. And then so the concern was if and when that started to happen again in 2024 or 25, then we could be faced with something similar. Now, of course, what's happened in the past 2 weeks, all of them, the S&P is below all of them by a good amount, which is evident. But I think what's going to be more important is to see after this rally attempt and maybe what happens in the next 2 weeks, how the S&P then reacts to this as well. Are they going to be resistance? Are these moving averages going to continue to roll over? So I think I'd be very surprised if we're right back to new highs after what we've gone through, right? That's the bottom line.
Me as well. And at the bottom window here, and this is some stock charts which I use as well. You clearly use it better than I do, but down to the bottom pane, you've got the relative strength index. Can you explain how that's calculated and what it's showing us here? I think this is important that you've got this.
Sure. The RSI is just that, I'm using it as a 14-week and just tracking momentum with that. And so I think what's interesting about this is that you can see sometimes that divergences, right, can last for a long time. So for instance, as I was starting to show this in the summertime, when the RSI was at like 80 down to 77, 69, it was still overbought, but getting weaker as it goes along. So I always use the RSI as somewhat of a warning sign. Sometimes it gives a lot more information, but so the point was, I wasn't going to tell clients to get out of the market just because the RSI was moving lower, but also showing that the first sign of the market starting to roll over back in 2021, 22 was, I don't have the line there, but it was also very similar where that started to see momentum on a weekly basis even start to fade. And so if and when you get the S&P below those moving averages and they start to roll over and you have an RSI that's moving lower, and those are three definite signs that momentum has shifted.
Is it trend that's important here with the RSI and level, or is it and or level? I mean, I see when it gets below 50 is where it tends to break down. Does it matter so much, or is it more trend?
I use both ways. So for instance, the strongest uptrends, especially on the weekly basis, the RSI will oscillate between the upper half of that scale and overbought, where the reverse, as you can see in 2022, didn't really get above 50, right, until, again, beginning stages of 23.
So these weekly averages, something we should have, this will be another data point today. We'll add it on to this. And then next week will be important, I think.
Yes, for sure.
All right, let's pull up this weekly chart here. Weekly decline of at least 9%. Explain what you put up here for us.
Right. So it's funny. I thought this was like a really important one last week, and then we have 9% up a day this week, right? Wild. But
that'll teach you.
Yeah, right. But it also is, I thought this was interesting because 9% down weeks just haven't happened that much. This is going back 50 years, right? You see how many times it occurred.
Yeah,
87 crash, twice in the internet bubble bursting, only once, or maybe once or twice in the Great Financial Crisis, COVID, and now. And so again, it just shows us this is bear market activity, whether it lasts or not. I think it just shows that investors have to be careful. You just saw what happened.
I mean, COVID, it looks like it's close to the bottom.
Yeah.
Financial crisis, not quite.
Not quite.
.com, decline, not near it at all. And then 87 crash was pretty much right on it again.
It was on it, but I'm sure you remember.
From my table I showed earlier with the 87 crash, it was quick to the bottom, but it took a long time to reclaim that high watermark that we had.
Yeah, I mean that's crazy to think how much you had to claw back at that
like
point.
a year.
Right.
Like 89 it took to get back to that.
So I think it's also interesting to see like on the bottom portion of that chart just shows the rate of change for the week. And even though some of these marked lows, you can see how exaggerated those weekly movements continued to be, both
These
up and down.
areas during bear markets, right?
Yeah. And that's why I think investors need to know too, is like volatility does cut both ways. And we just saw it, in extreme fashion this week where you're on the right side of it and something comes out, all of a sudden things rally 4% in minutes, right? Even though a stop is not going to take you right out of that. That's buying way up with everything, all the algorithms pushing it higher. So, I think overall, I'm sure you've been talking about this, Jeff, as well, is investors need to, pre-plan some of this.
Hmm.
understand it's coming, and that even if we have hit the low already, it's going to be, it's going to take a while to get back to what we had before 2025 began.
So when these, before we jump into some of the other signs, you got a couple more charts I want to go over of yours. What what were you telling clients, or what were you telling, readers about, adjusting these, portfolios earlier this year? I mean, I know some other advisors that, they switch people into some more bonds earlier on when you get below the 200 day, nothing good happens below 200 day. People shift
Yep.
a little more bonds. What were some of the maneuvers that you were writing about, telling people, could be helpful?
One of the things I noticed, I look into market analysis as well. And so, for instance, when the S&P was starting to struggle, you started to see, of course, European indices start to outperform. And even more in particular, those European ETFs are pricing US dollars with the dollar falling. They were just going berserk.
Right.
So one relationship I talked about a lot was the EWG, a Germany ETF versus the S&P 500, and that spread just got way out of whack. And so saying that it looks like a very good breakout longer term on a monthly basis because it lagged for so long, but I didn't think that spread could continue. And the question was, or the concern was, if and when that happens, is that going to take that capital and have it flow back in to the U.S. to close that, or is it going to be one of these catch down events where all of them have to eventually roll over? Now, we didn't know it was going to be because of the extreme tariff declaration, but that did happen. Even when the dollar was continuing to go lower, look at the EWG, completely rolled over, bounced, now it's back up again. So I think sometimes, even when things aren't moving a lot, there's other areas you should pay attention to realize the relationships, and sometimes those spreads need to be corrected.
So where do you think people should be positioned right now?
Well, I think we have to realize that the safe havens to continue to work. There's no reason why gold can't continue to go higher. I think you just have to recognize the fact that that's going well. But I try to point out relative strength within some individual stocks too, and I think it's important to realize, especially in the areas that are doing poorly. Like for instance, we're talking about, just to give you two examples, eBay and Netflix,
Hmm.
both haven't broke down yet, both above rising 200-day moving averages. So they're going to report relatively soon, whether you like them or not. You have to recognize why are they moving higher. And one particular quote I'll never forget from Alan, he always says
Now,
was,
sure.
"In price, there's knowledge," right? Meaning that we don't know why these are going higher, but maybe someone does, so we should pay attention to the price.
Those whys are elusive. Um, yeah, you can see why Netflix and eBay. People are clearly looking for deals on eBay and looking for escape on Netflix.
Right, exactly.
So let's look at some of your capitulation signs here. Let me see if I can share the screen here again and get into this couple of these maybe.
There you go.
All right, these are some capitulation signs. What is this confluence of support and reversal business you're talking about here?
Yeah.
There's the
So
4,800 I had mentioned that you have on your chart.
yep, perfect. Great. So I think one of the things, Jeff, I'm sure you know this as well, when do people ask about support levels the most? Well, the market is going down relentlessly and it don't matter. And so that was, of course, the case last week. And so all along the way, you could pick any point on the way up, to suggest maybe there's going to be a point. And I always say you're in pure price discovery, pure support discovery mode until a new level gets established.
Right.
And so, we had those crazy days last Thursday and Friday, and then the open 4 or 5% lower once more on Monday. And at that point, just when people were getting too concerned about it again, you blink and literally everything was up 5 or 6% from that point. So it happens quickly, but that type of action is capitulation, whether it's short term or something else. And when it happened near that 4,800 mark or thereabouts, which was right basically on the October or the 2021 high, it also was right near 50% retracement mark. So in hindsight, that's a confluence of support now. That's right where the low was this week. Again, in two other areas that way. And I think that at the very least, it gives everyone a frame of reference to work off of. And I think that's one of the major reasons why it held those last few days this week, even though it came down, twice. and came close to testing it. So I think, if this is going to be a real low, it has to be defended. And I think so many people are on it right now that there's probably going to be a stop loss for many people too.
I want to draw a line from this October low through this October low, and it looks like it's coming up to this point also.
Yeah.
That's
Yep.
that's of interest.
Right.
So yeah, I'm looking at this is making me think about some other things here. So back to the 22 highs, the late 21 highs is kind of what we're sitting at right now. It looks a little tenuous. We
for
have to
sure.
hold this.
Yep.
It's
And I think,
important.
yeah, exactly. There's no guarantee for anything, but in terms of going from one way down to at least two-way price action, we needed to see that happen at some point. So we'll see what we do with it, but that was one indication.
Then there's the volatility, the VIX.
Yep.
What did we hit? Did we hit 60 or 57 or something the other day?
Yeah. I think it
That's
grazed 60. And so
it's 60 print, like opened at 60 one day,
I
right? The
believe so.
VIX.
Yep.
Yeah.
Yeah, exactly.
So this is you got plus 260%. This is the move. VIX is up 260% in a couple weeks
Yeah, like I think it's
or
like 6 or 7 days,
7 days. Yeah.
trading days.
This is daily. Yeah.
Yeah. So
And what is that?
obviously, yeah, so I was just comparing it to what we saw in August. And August, of course, was, different, but at the same time opened up so high, right? And 65 up of whatever it was that day, but almost 100%. And then it came right off. So we know what happened in August. That was the beginning stages of the comeback. And so August started with three straight 1% declines, then ended with seven consecutive 7%, seven consecutive 1% moves for out through the remainder of the month. So we don't have that yet. But at the same time, if we're looking for anything different on the way down, it was to see the VIX really spike, which of course it did. And again, with that coinciding with the S&P 500 getting back down to the area of support holding, it got a little more encouraging to not at least not sell anymore at that point. And so it's different now because as we can tell, it's been hovering near the 50s, 40s, 30s since then. So that's not the best feeling going forward because you need to see that get back down. I would say at least to the 20s to get more.
Got to get under 30 for
Yeah,
for for it to for things to be calm enough to get back in, to go full, to both feet in the water.
right. But I'm sure you've seen these studies too, Jeff, recently. There's people coming out and saying, if you buy stocks when VIX hits 30, you're like, it's a great entry point for longer term, which I agree
I was
with.
saying to myself, you got to buy stocks when the VIX hits 50.
Yeah, yeah,
That's what I think is more realistic. You want to sell when it goes through 30 and then get back when it gets to 50 is kind of, I mean, we want to do some more research on that, but that seems like what's been happening lately.
yeah. I mean, that'll be an amazing trade if we can put that one on every time it happens. That's for
If you
sure.
if you had the stones to do it, right?
Yeah, exactly. So anyway, I think these are starting points coming in,
Right.
and of course, we had this conversation last Friday. There was no indication of this happening yet. We feel that maybe it was getting really bad, but at the same time, it was a nervous feeling through the weekend for sure.
So are there any other bear market bottom indicators or signs that you're tracking or that you've seen? I mean, I look at some sentiment. Investors' intelligence has just gotten bearish. Not enough, not as bearish as it was. I was thought about pulling that chart up here, but I guess I'll show it during the week or something. That quite hasn't quite gotten to that level yet. I'm going to take this down here and we can just
Sure.
talk. What else do you see out there that might give us a clue that we hit a bottom?
Well, today, the title of my piece was "When do you use short-term charts?" And I said now. Because if I'm looking for patterns, you can't see it in that, right? Especially this week. It's just like up and down, there's vertical lines back and
Hmm.
forth. But if you zoom in, it didn't have a chance to give them to you, but if you zoom into the 30-minute and 60-minute charts, those look like potential cup and handle formations across the last few days. Now, again, short term, we're talking about huge patterns now because of the movement. So in terms of like where those could go, the levels are pretty high. Just a matter of are we going to see a hold of these breakouts just because of how volatile it's been? I'm going to say no. It's going to be it's not going to be clean at all. So we'll probably have to redraw those a bit. But again, that's what kind of thing I look for when the market gets really oversold. And actually looking at a 2 hour time frame back in March to April 2020, it's the first time I saw a bullish pattern. It actually held, and that set the stage for the comeback. Didn't know at the time, but that's
So
why I
this
continue to look for that stuff.
the same bullish patterns or bearish patterns that you look at longer term, you just zoom in
Yep,
and get
correct.
intraday or half hourly or something shorter time frame than that.
Just to see what's going on. So you
And you're
get,
seeing that some of that's starting to materialize. That it's got to hold a little bit more, but we're starting to see some of those shorter term patterns indicating we're near a low.
right, tradable low. So for instance, like that low
Traded.
from the low from Monday, then the higher lows, and the big rally. So I was talking about to some clients today that if after Wednesday's huge spike, what was the best case scenario? Not to see it continue higher. That was probably not going to happen. But
I
to
think I
see,
heard it's so it for it to not give back more than 50% on
yeah,
the at the close.
there you go. Yep. And
It
then
was
have a little
down. It
bit of
was
a
down
bid.
2/3 intraday. It gave
Yeah, it
back
was
two
scary.
thirds of that gain. It went. I think we got to get back through that 5,500 level. It's kind of where we broke through. So, you mentioned the dollar briefly, when we were talking before. There's a lot of talk about the dollar. It's getting weaker. Or it's been weakened. Is that an issue for you? Anything insight? Any insight there?
Well, it's interesting because if you're talking about weaker dollar, that was one of the key reasons for the 2022, dollar top and S&P started to rally. Now I think this is a different animal at the moment. I have heard some arguments that, tariffs could be, you know, deflationary originally, or down
Mhm.
the road. Maybe this is part of it, but when you have the dollar moving one way and yields moving the other, I think it confuses the situation completely. But I think it's
So dollar
more,
dollar and yields go in the opposite direction.
yeah.
Does that
So
mean people are selling the U.S.?
I think so. I think that you have a lot of knee-jerk reactions right now. And, I know we're going to maybe just gonna go into recession talk or GDP and all that, but I think the short-term risk is high for all of that. Just
Yeah.
because what can you do? People are scared. But eventually, I think you have to decide, does that, cause demand destruction? Are people not going to buy at all? And that's going to bring inflation down, maybe not the way we want it to. But I think we're not going to see what the result of this is. I don't know how long, probably longer than a year, 2 years, and to see if there's actually
I mean,
factories being built and people coming back in.
it's not going to hit Main Street or the GDP numbers and for at least a quarter or two. I
Right.
mean, this stuff's not going to get show up in the economic readings until we can. I mean, it's got to be able to look back a little bit. I mean, I'm thinking Q3, which lines up with some other you know post-election year weakness. So, what's your feeling on recession? Are we on the brink? Are we close? Some people are saying we're in it. You think we? I mean, at least the odds are increased.
Yeah, I don't think you can say no to that. And, I guess depending on what industries you're looking at as well, we're going to feel it more. But, I feel like we've been talking about potential recession or guaranteed recession for like 3 years.
Well,
Obviously, right?
that's a whole other discussion. I mean, the people that were wrong for the past 3 years are now coming out and saying they're right. I mean, that
Oh
whole
yeah,
inverted yield curve silliness.
exactly. So I think, listen, the risk is elevated, but I don't think anyone can deny that.
P.S. We had two negative quarters in 22 that they changed the rules on. It was two negative GDP quarters, right? Q1 and Q2 of 22.
Um, yeah, and so then things got reversed eventually. So I think we can all, pontificate about what could happen, but as a technician, I can always escape that talk and just say I'm focusing on the price action.
There you go. So, what's your approach for trade ideas? You sort of intimated or hinted at a little bit. How do you put together trade ideas for clients in the newsletter?
Well, I think everyone has their own way of finding ideas. I have a few simple screens that I look at first to try to identify relative strength sometimes in a market like this, things are oversold, maybe showing a divergence like the RSI, but also want to always see that again, if I see a confluence of support, it's better than just one, something moving average or whatever. But like for today, just looking through some charts, a few things popped up where I thought that, clients should be aware of, just seeing maybe some stocks that have been basing a little bit with a lot of potential air pocket of resistance above, right? And so identify that. So usually in bull markets, there's two different plays I'll call it, look at just classic bullish pattern that develops. So again, inverse head and shoulders pattern, cup and handles, and then also, when something gets pretty oversold into support in a long-term uptrend, right? So now
Hmm.
there's not too many long-term uptrends right now that haven't been wrecked yet, but there are a few. And again, I brought up two of them before, and that's what I want to show. And in addition to that, pretty soon, I think there's going to be some short ideas as well. Like you mentioned, stocks have been rallied up to 5,500. So if some of these bullish patterns fail on the shorter term basis, which I talked about on a 30, 60-minute chart, those are going to look like just rallies into supply that are worthy of shorts, in my opinion.
Kind of like the short. So the short analysis is sort of the inverse of the long, and vice versa.
Yeah. And
So go ahead.
no, so a lot of it just depends on the market that we're in. So right now, again, whether we're in a bear
Well,
market or not, this type of crazy action is bear market activity. So that means sharp rips like that into resistance, I won't trust, right? Either don't buy them there or short them there or sell whatever you have.
sounds like a little bit of a top-down approach.
Yeah,
The market
totally agree.
trend and then get into the individuals. So
Correct.
you run through a lot of different asset classes and stocks. You said you had a couple of charts. Are there any ideas, any names you can throw out? Just an example of something that has popped in on the long side?
Yeah, today was HII, which was a defense stock that got crushed a few months ago, and it was percolating. Actually, got upgraded this morning, and even though I knew it was trading up pre-market, it just looked different than anything else I've seen. Again, getting above a certain level would have gotten you into this really big area of
What's that company? HHI?
HII.
HII.
Yeah. So you can see
That's
it was up 8 or 9% today. So it gapped higher, but they kept going. Again, didn't know that was going to happen, but I wanted to make sure that our clients were aware that there is an inverse head and shoulders pattern here, that something that's been basing hasn't really fell that much when the rest of the market was going down. It's a defense company as well. And it got some upgrades this morning. So all those ducks were aligning. At the very least, identify it. And, it looks different than anything else from that perspective, at least.
anything on the short side?
So many. I wouldn't say I didn't
That's
concentrate on.
that's a bearish trait right there. They
Yeah,
get
yeah.
so many
Well, I
short
should say this
ideas.
eventually. I didn't put any on the short side coming
Nothing's
into this because I just felt that again, what we saw from the early of this week, it just seemed like there was enough evidence for at least a bounce. So again, if and when these start to fail into next week into resistance, then I think a lot of them will pop out.
so you've got a few queued up for when they fail or
Yeah.
if they fail. All right. Um, Friday afternoon, getting late. Let's change gears a little bit. So what do you do for fun, Frank?
Well, I like to play golf, but I haven't played it in a long time.
Dude, we got to go out.
Oh, definitely. Let's do it.
Golf's great. I'm gonna be playing next week.
Oh, good.
Yeah,
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 it's getting nice out. And
yeah,
so,
yeah.
yeah, and I guess the phrase that someone told me one time when I was having a frustrating time out there was like, you don't play golf to relax. You relax to play golf. So it's like, all right, that's
Well,
true.
you got to make a few shots. You got to practice a little bit.
Yeah, exactly.
You got to think about it. It's all between the ears.
Right.
So what else is coming up for you? Anything new? Any events? What's on your calendar, your schedule?
I've had a few different trips, but I'm going down to speak at an event in Myrtle Beach. Do you know Jared Dillian of the Dirt Nap, Daily Dirt Nap?
I do not.
Oh
I've
yeah,
heard of it though. I don't
he's
know.
been around for a long time. Actually, he's a big inspiration for me starting CappThesis because he started Dirt Nap right after the great financial crisis. He was at Lehman, and so he
Hmm.
was writing content for his clients, and he started back then, has continued and really created an outstanding business. And so this big joke because he's invited me to come down there and speak at his conference, and it hasn't worked out. And he's like, "You have to come down now. It's changing next week or next year." And so I'm doing that in 2 weeks.
Myrtle Beach, that's like golf
Yeah, I
central,
know.
man. I mean, don't even worry about bringing clubs. Just rent a set down there. They'll probably be better than the ones you have or
That will
that are in your
guaranteed for
garage.
sure.
Go to the range, stretch, and go out there and have some fun.
All right, sounds good.
Got to keep your eye on that ball, though.
That's right.
All right. So how do people find more out about CappThesis? We got capthesis.com. You're on LinkedIn, right? Where else are people looking for you?
LinkedIn, you can go to if you go to YouTube, just type in CappThesis. Got plenty of videos over there as well. Those are probably, and of course X. So those are the three main ones.
And X. What's your handle on X?
Just Frank Cappelleri, my full name.
Full name.
Yeah.
Excellent. So
Just type in a lot of vowels and consonants, you'll get it.
just Google Frank. You got
Yeah.
it. Listen, man, this has been great. I'm glad we got a chance to get into the tacticals. Tough time for tacticals right here with
Yeah.
historic events going on. So thank you, Frank, for stopping by. I want to thank everyone for joining us. Again, I'm Jeffrey Hirsch for WealthWise on Biz Talk Today TV, available wherever you stream your podcast. If you want to know more about me, the Stock Traders Almanac, you can Google it. You can Google my name. You can go to stocktradersalmanac.com. LinkedIn as well. I'm at Almanac Trader on X. And I'm not going to see everybody next Friday. I'm taking the week off. I'm going to be heading out for a little sun with some friends. We're going to play some golf, go see some music, and hang out. And I'll be back in 2 weeks. So thanks, everybody. Take care.
Thanks, Jeff.